Vibha Padalkar is the MD and CEO now joining us. Thank you so much for taking time out. To begin with, we saw 130 basis points fall in the VNB margins. Can you give us more perspective? Is it falling due to a change in the product mix or is it due to an increase in competition?
It was largely due to two. So our margins last year were 27.6%, and this year we ended at 26.3%, which is a difference of 130 basis points. So when I deconstruct this, 70 basis points was due to a one-time 1,000 crores of premium that we got in last March because of the budgetary announcements of 5 lakh and above cases becoming taxable from 1st of April of 2023. And hence there was in a way a fire sale and that 1,000 crores, which we called out at the beginning of this year itself. And so the 70 basis points because of the increased premium income that came through. Another 40 basis points impact is due to the product mix, of which the biggest one is on unit linked. Unit linked as a percentage of overall our new business premium almost doubled from about 19% to 35%. Now, this would have had a higher impact, but we managed to sell more of term and riders and so on, and hence reduce the impact of higher unit linked to keep it at about 40 basis points.
Sure, Vibha, that explains the movement that we saw this quarter. But just to get more clarity on the outlook of the VNB margins, because you did comment in your con call as well that you're flexible to trade off the margins to get the VNB growth. So how should one look at the VNB margins going forward in the coming quarters?
To clarify that we are not talking about a material fall in VNB margins. All I'm saying is that let us be range bound so that 100 basis points fall here or 50 basis points or whatever that might be. Because I'll give you an example. If equity markets continue to stay fairly robust and hence interest in unit links continue, then I don't want the conundrum that do I say no to a customer because it doesn't fit into my overall margin profile, or do I say yes and increase my touch points with the customer as well as onboarding of new customers so that I can down the line upsell a more margin accretive product to that customer. So that's the I want to have that flexibility, and hence I mentioned what I did. But at the same time, it's going to be reasonably range bound, all things being equal, of course, on the macro aspect, COVID and regulatory aspects and so on. Based on the current business scenario, it'll be range bound. But what we will be focusing on is on the top line growth as well as VNB growth.
Okay, ULIPs are now at 35% levels, which I believe is also impacting the solvency to some extent, right? Now, after diversifying the product mix, which product you think will be driving the growth in coming quarters, Vibha?
What we will have is again a balanced product mix. Unit linked will stay range bound around this, either between a fourth to a third of our business. We are already beginning to see a rebound in non-par. And in Q4, we saw that in around 32% was the non-par from being about mid-20s just after the budgetary changes were announced. So that will continue to move upwards, and maybe a third of our business is where a third to about 35% of our business is a good place to end. We are seeing inching up of term APE from about 4% to 5% if I were to look at Q4. So that will continue to inch upwards in terms of contribution to business. And also par that has gone slow for some time thanks to unit link. That also I would expect to see a recapture of demand for par products. So that this combination is how I would see getting back to a more balanced product mix.
Right, so how are you penciling in the impact of the proposed regulation on the higher surrender value for non-linked business on VNB margins and on growth?
So just to recap, very recently, our regulator has notified the surrender regulations, and those are not very different from what we are doing today. For example, giving a longer free look-in period. For example, having a higher SSV, the special surrender value. we are fairly in or thereabouts in terms of the ballpark of the expectations of our regulator. We were already giving higher than absolutely required level of SSV. So the gap in complying is not onerous at all or material at all. We'll see in terms of whether there are any other changes that happen. But as of now, we think that the regulator also understands how the product construct is very different to any other product construct or financial services product that might give more liquidity but gives no guarantee. And by trying to match something in terms of liquidity, we might more or less distort the architecture of these products and not be able to give a long-term guarantee. So hopefully, while we address any customer complaints, but at the same time, we don't tinker with the architecture of the product excessively. That's where we are today. But coming back to your question, the notified surrender regulations don't have a material impact on the company.
Okay, the surrender applications won't have a big impact on the company, but I do understand that you're looking at expanding your distribution network as well. Do you think this is something that can make you achieve the higher end of the anticipated industry growth, which stands at 13-15%? Do you think HDFC Life can outperform that?
Yeah, I'm reasonably comfortable saying that we should be on the upper end of where the market is. And we will, of course, try and beat market growth, but at least on the upper end should certainly be possible. You've seen strong counter share growth at HDFC Bank. We've touched the watermark of 63% from about 58%. Hopefully, we'll continue to inch upwards. Also, our agency channel that has grown reasonably well in the below 5 lakh has expectedly been hit in the above 5 lakh. So with a base reset and with 80,000+ agents that we have added and 75 odd branches that we have added, growth should come back in our tied agency channel. Growth is anyway being seen in our variable agency model, which we acquired from Exide Life. So that is something that we should continue to build on. Some of our wealth channels, I'm reasonably hopeful, should start coming back into the fold. As a result of which, I think we should be able to get to the upper end of industry growth.
All right, and despite the increase in the distribution channels and having a strong network of HDFC Bank, the growth rate is still anticipated around industry levels. Is it just pessimistic commentary from the management, or do you think that there are actual headwinds arising, such as competition?
No, it's purely because of the overhang of taxation, nothing else. Because if you were to look at below 5 lakh, we have grown in the range of 13-14%. So to expect that we suddenly have a great amount of visibility of mid-20s, while internally we would certainly gun for it, but we need to perhaps go through a couple of quarters to be able to see how robust the growth is for the below 5 lakh ticket sizes.
For making time and speaking with us.
If you like this video, then like, share and subscribe to ET Now.